Hello and welcome to yet another video, which is going to focus on several leading sectors of the S&P 500, and it's going to be communications, discretionaries and retail. I will dive into quite a few tickers, compare their performance, their outlook, and put it into context of the macroeconomic changes that we had seen unfolding ever since both inflation sets of data had hit the news. You know my site and all the dedication that I am expanding practically daily ever since February 2020, with the notable break necessitated by me breaking free of the prior, let's call it professional engagements. So let's dive into this overlaid chart, which shows the candlesticks of SPY and overlays of both discretionaries and communications. And you can see that ever since elections they had started catching up. Note as well that within this video I'm not covering yet another outperformer, which I had called in good 1 to 2 weeks ago, and that was TAG, going from IGV towards stabilization in semiconductors and so on, but that's a topic for yet another video. This video originated from one-on-one request dedicated to one of my clients, a great person. And this one talks, and you can see quite nicely captured on the chart, the communications and discretionaries, how they had been performing ever since the good CPI hit the wires and the bad set of Thursday's data, the double punch, and how they had performed and withstand both days, because we are as well seeing quite a shift in yields that are starting to rise and rise again. So this checking of tickers that I will follow in the next part is typical stuff what I do with clients one-on-one, whether they shoot me on concentrated question or ask me to comment on one or two tickers here and there only. So let's start with one of the good ones, and it's Netflix. And you see it already being positioned before the elections and not at all selling off and then building on gains, and we are now kind of, well, it's not a flight, but it's an absence of consolidation into slightly retreating rate of change. So there might be some consolidation still ahead, but the uptrend is not dead, even though CCI is as well a little bit weakening, and MACD histogram is already negative, so be wary of this one. It's starting to undergo a very shallow consolidation. Roblox is the one that has more upside momentum, and it's not being really yet questioned, so the time window of opportunity for extending gains is certainly there, and probably a little bit better than in the case of Netflix. Google, it's all about the below range, and now let's see whether it stops retracing here and starts basing approximately in the 187-86 area at worst, and embarking on a fresh uptrend continuation. Certainly the rate of change is positive, and there are no clear warning signs, but I would give it a session, maybe a session or two, to see whether the sellers attempt to come in with any kind of force or not. Absence of force, absence of conviction is of course a good sign, so this is as well one of the better charts out there. Moving to retail space, you know my views about and comments about University of Michigan consumer confidence data and what it's likely to translate in Friday's retail sales into. These are quite bullish charts reflecting the enthusiasm following the elections, but now bears can't stage a move because the rate of change is practically neutral. Same for MACD histogram, and I don't see the sectoral outperformance as of now, but more of intra-sectoral rotations. You remember me weeks, months ago talking about the difference between Walmart and Dollar General discounters. So this is just one illustration of the intra-sectoral rotations. Moving to Amazon, it started to catch on fire as well after elections. The momentum is still good, and I do not want to see a pullback extending below 225, 224. That would be a great buy zone if it ever gets there. Moving to another part of where consumer expenditures are going, Norwegian cruise lines, and this kind of reflects the newfound dollar strength. That is, however, a bit being checked. The dollar is not extending gains, even though yields have clearly embarked on a fresh rising trend. So this is a bit of a cautious chart, potentially under distribution, so be wary of piling in with anything approximating outsized conviction. Booking, that's looking a bit better, but as well here you can see the waning momentum, but it's not critical, but slightly better than the preceding chart. Expedia, well, slightly worse, and you can see the hit this one took with the bad set of Thursday's data, when that has consequences for ease of obtaining fresh money and the Fed rate cutting path. So be wary of that, and it's with 1 day lag perfectly seen in RBNB as well, which is practically the worst ticker chart that I have brought you today, and it's something between 10 and 15. So within this view you have had the enjoyment of diving into the sectors and going from the sector to select the stock winners, whether you play them directly within the stock, within calls, within puts, or within warrants, whatever. This is how it's looking, and when I said warrants, I want to really highlight the hyped expectations of Fed rate cutting. I'm afraid that Powell will somehow spoil the rate cutting party, the Santa rally, with a dose of reality, and that brings into question, ever more than it already did, the January and March rate cut expectations. You sure know the join URL on my site, which is helping you choose the right product for you depending on your trading style and the breadth of instruments covered. Forget not about the direct one-on-one support that I'm giving you chiefly over Telegram, and I as well accept chart requests like I did today over both Telegram and Twitter. You know my trading story. I've somehow touched upon that in the beginning part of this presentation. Obligatory disclaimer, and let's have a great pre-Christmas week.